Chandresh Nigam, a Managing Director and CEO of Axis Mutual Fund, is now joining us on the show. Chandresh, thanks very much for your time. Appreciate it.
Hi.
I want to just start by asking you, what is the dominating driver for the market? Is it earnings? Is it liquidity?
I think short term it's always liquidity and long term it's always earnings. Ultimately the market does reflect earnings. I think the last move from the lows which we saw around the budget time, I think obviously we've seen from the index moving from 7,000 to now 8,700, so about a 25% plus increase. And I think both of these aspects, one is expectations of improving Indian economy and hence earnings, and the second is obviously liquidity from a global perspective where there are not too many opportunities available worldwide. I think both of them are making the market move the way the market has moved in the last now 5 months or so.
I know you track global markets closely as well, Chandresh, and you have a view, more importantly. So what is that view? Will global liquidity remain extremely easy, sanguine, so no reason to worry about that?
Yeah, I think liquidity will be very easy, and this is not a short-term call. I think this is a more medium to long-term call. I think generally we are seeing a significant change in the trajectory of the global economy. I mean, various factors are being talked about, whether it is demographics, whether it is deleveraging, whether it is just plain disruption because of technology. We are seeing an extended period of time where global aggregate demand is likely to be weak, and people are essentially hence worried about deflationary forces, and the central banks are really trying to avoid deflation really setting in, and all kinds of things are being thrown at that to counter that. If you have that kind of a view that we are going to have a very slow global economy and deflation or deflationary forces will remain strong, then you have to have a very different strategy in the markets. It basically means businesses which are more me too, businesses which are more just dependent on the cycle. And we are not going to see a strong cycle anyway. I think those are not the businesses you want to be in. So it is in these environments, businesses with pricing power, more importantly, sustainability of pricing power for a longer period of time will become extremely, extremely critical. On the other side, you have worries on disruption. I think technology is enabling many new models of business, not just in India, but globally. So as a portfolio manager, as a fund manager, as somebody who is trying to create and build wealth over the long term, you need to look at both these aspects. On one side, global slowdown. On the other side, disruption, new business models. And hence that leaves you with a narrower set of businesses to really bet on from a medium to long-term perspective. And these are businesses which will have pricing power and will continue to have pricing power. And that's why you are also seeing that these are the kinds of businesses which have been really in demand, not just in India. India, certainly, we've seen many of these businesses now quoting at lifetime highs, PE multiples of 30 plus, etc. But the same thing is happening in many other global markets as well. The market is getting narrower. And as I think this economic trend persists where the global growth remains weak, and at the other side you will have a lot of disruptors and money generally being available easy, so private equity supporting a lot of the new business ideas, etc. I think you will have to focus on a more narrower market where you can be reasonably confident that significant gains can be made over the medium run. So that's our view at Axis, and we would like to continue to kind of invest in these high quality businesses with sustainable pricing power. And that's where we think money is going to be made.
Okay, Chandresh, a lot more questions lined up, but for now we have to take a very short mandatory break. We'll conversation with Chandresh Kumar Nigam, the MD and CEO of Axis Mutual Fund. Thanks, Chandresh, for waiting by. You made the point earlier about how global liquidity will continue to remain benign and it will be abundant. Does that mean we should stop fretting about the valuations of high quality stocks that you would prefer to pick in your fund?
Yeah, I think liquidity will remain. I think there will be obviously some cyclical tightness which will happen, and worries on the Fed tightening, etc., will keep happening. But I think medium term, my view would be there's be enough liquidity available. The central banks will keep throwing money at trying to fight the slowdown or fight the deflationary trends. Now, the question obviously is a very pertinent one, which you ask is, so how does one balance liquidity with the kind of valuations? And there will be times when, despite the liquidity, the valuations may not be justified. And I think there are some such pockets which might be emerging where the last 2 or 3 years of growth is being projected that will continue over the next 5 years or so, and hence significantly high valuations are being justified. I think time will tell. I mean, if the growth story continues, if the cash generation is there, if the operating metrics in terms of ROE continue to improve, then these valuations will sustain. So I think you have to be very selective. I am not for once saying that high PE or so-called high valuations mean that there is significant downside, but I think one needs to be a little cautious to see whether that valuation is really, really justified. As I said, the cost of equity is probably coming down.
Just to flesh that point out, what is your view on the subject? What is your view on the subject? Because, I mean, if earnings have been growing at, say, 25%, stocks trading at 40 times, earnings drop off to, say, a trend growth of, say, 20%, should it still trade at 40 times? Is it possible the valuation even moves higher? Because you began by saying aggregate demand will remain weak, throw in disruption, etc., everything else as well. And then you got liquidity. So what is your view on the subject?
Yeah, so I think what is liquidity essentially at the end of the day? At the end of the day, it's basically saying the expected return which I want from that stock or from that asset is lower now. The cost of equity is lower and money is chasing wherever it can get a reasonable yield. Now, if your overall cost of equity, which generally in the Indian market people think is about 15-16%, is down to 11-12% because alternate opportunity for cost of money is coming down, and certainly coming down globally with negative interest rates the world over. I think what used to be expensive at 20 or 25 multiple will now look expensive only at 30 or 35. So I think PE is in some sense derived from the general conditions. If the long-term view on interest rates that is low and opportunity available is going to be low, you are going to see higher PEs stay there for longer. But at the same time, as I said, so I think higher PEs for sustainable businesses is here to stay, and I think it will probably, that trend will further exacerbate, in my view, where limited number of businesses which have it in them for higher growth will continue to see higher valuations. I think, and it's just a simple math. If cost of money is down, but businesses are earning more, they will have to be valued higher.
Yeah.
And that trend, I think, will continue and further gather steam.
30-second response to this one. What are your absolute overweights? I mean, what do you buy?
So I think in this environment, overall, I think the trend is all about direct to consumer. I think so B2C businesses is what you really want to look at. B2B, we are seeing very few cases where pricing power is available, and more so whether it will sustain or not is a worry.
Okay.
So all B2C kind of businesses, whether it is consumers, consumer discretionaries, passenger vehicles on the auto side, select pharma, retail financial businesses, whether it's on the banking side or on the NBFC side, I think we are all we kind of quite positive on many of these businesses, where there's an ability to interact with consumers directly and
raise prices. Got that.
Gets reasonable pricing and maintain your prices and reasonable pricing power. Absolutely.
Chandresh, thank you very much. Good speaking with you. It's always a pleasure, and hope to see you again soon on the show. Thank you.